Well, Doug, here we are. It's been a very volatile year so far. In fact, we've had more extreme trading days than, well, only number two to 1987. So this is the second place for most volatile, number of volatile or extreme trading days in the year. And we're not even halfway done with the year. So of course, a lot of people are concerned. It's just not a good feeling when you watch your account balance go down. So let's talk a little bit about this and put it in a historical perspective. Here we go.
So this one shows past panic periods, and what really the focus on it is there's been a number of panics over history, and what you find out is when you widen the view, the market takes a hit, but then it comes back and hits new highs. It always has, and it'll continue to do that. It doesn't feel good when you're in the middle of the panic, and you have a tendency to kind of think that this is it, it's the end, and it won't recover, but it will recover, and you just need to stay put into it.
And in fact, when we've looked at charts where you zoom out from a specific year like this, it's hard to even see some of these jagged down moments in the market.
Which is correct. And I think it's part of the problem when people see, when they're investing, they see these fantastic mountain charts where they see how their investments would have grown, but what they miss is all the ups and downs in between. And there is every year, and we'll see that later on.
I like we've talked about how it's akin to cycling, right? When you're going up a mountain, but that doesn't mean you don't have some downhill periods, even though you're climbing the mountain.
I like the downhill periods on a bike better than I like it in the market.
Good point. Good point. Okay, next slide. This one is looking at the average investor's performance in these periods of downturns versus the overall stock market. And if you can see the screen, it's an average investor, their performance is at 2.9% versus the overall US stock market, which is at 7.5%. The reason being that when we panic and we start changing things around or pulling our money out of the market, that eats into performance, right?
You're always losing. In fact, there's been studies by several large mutual fund companies where they looked at their investors and saw when people were moving in and out of the market on their own, their returns were significantly less than if they had just stayed put in the quality mutual funds they were in.
Which is a big part of our job, is to help you through these times and to encourage you to keep your money in the market, even though it doesn't feel great.
Another part of that study was when they looked at people who worked with financial advisors, they did an average of 2% better than people who tried to do it on their own. Mm-hmm. So that's the value part of the value we bring to the table.
Mm-hmm. Well, what about this chart, Doug?
Now this one, the blue boxes or squares are basically a down period in each year, and the gray lines are showing if it was up or down that year. Now the key one that I want to bring out is in the early part in 85, 86, 87.
I'm just going to point, this is 1987.
Right. I was around, I was actually living in New York City at that time, and I remember the day quite well, that it was a normal day, and I got a call saying, did you see what the market did? And I said no, and they said the market was down as much as 1929. Now I can tell you, everyone was in a panic. They were saying we're going to go into a recession and that the market wouldn't recover and it was going to be a terrible time. And what you find out, if you look at 1987 again, you'll see it actually ended up the year, or that year, up in positive territory.
That's right there.
So if you had started the year at the height of the market and went through the downturn in 1987 and hadn't panicked and didn't sell, you would end up the year with more money than you started the year. However, if you panicked right after the downturn, you never made the money back. And that's really the point of this slide, is you got to stay put.
And I think it's important. I mean, I've had clients make comments about the fact that we are down so much, it's hard to fathom the market making up all of that downward momentum and then even going up from there. But that's what this chart is saying happened in 1987, right? Not only
Not only
does
that,
it,
but you can see it happened again in 1990, well, not 1990, but you can see other years like 1997 it did it, and 1998 it did it. So you can see that it occurs over and over. Every year has a down period.
and this is just a more extreme.
This is a more extreme, more volatile, but it's not any different than right now in 1987. So there's a good possibility, and I've been saying it, that this year could end up
In the
still
positive.
in the positive.
Which again means if you're down 20% in your account, the market's going to go back up 20 plus.
20 plus. So you could
Potentially.
you could end up at positive 8% for the year. I think that's a realistic amount. It may not happen, but there's a good possibility it could still happen.
Let's hope.
Yeah.
And then for our last slide, this is really illustrating what happens if you were to try to time the market, which is the black line, versus the green trend line showing if you had just stayed in the market and held on to quality investments. Yes, there are dips, but at the end, you end up with $33,734. If you'd started out, in 1936 with $100 invested, you end in 2016 with 33,000 and some odd versus 10,435. So essentially triple the amount over time just by holding on to those quality investments. And that's what we really want to emphasize, is being invested in good quality companies.
Yeah, and if you own quality companies, value always returns to quality, and always has. And we of course want our clients in quality, so that's what we recommend. So why don't we switch over to the dolly, and we can look at what we're seeing for the short run, and what we've been telling clients. Why don't you highlight the areas here?
Okay, so at the top here, so the dolly ranks the different sectors. The top is going to be the best. Green is the best. So commodities, no huge surprise there if you've been watching our videos and or the news. Inflation, in periods of high inflation like what we have now, commodities do well. If we go down to domestic equities, what's going well in the U.S., it's mid-cap value and small cap value, so your medium and smaller sized companies that are more value based, and basic materials and energy. Basic materials being your non-precious metals, oil, other commodities.
Steel would be in this category under the basic materials, and those kind of things. And so we've been telling clients, we started in early January because the dolly actually showed us this, and we've been moving people into, say, natural gas is another one that we've been buying into. And so that part of their portfolio is up. That's for the short run money, but the long run money is still these great quality companies that are selling at some 30-40% discount. And we think that eventually that the return will come back to these, and they'll actually outperform for the long run. So we're kind of like in a two-prong way of attacking this. Half is in commodities and basic materials, and half in high-quality growth stocks.
Half?
Well, not it can be different for period, but it's the two-prong approach.
Okay, all right. Well, that's it for today.
And we can't cover everything here, but if you have questions or you would like some recommendations, please give us a call, and we'd be glad to help you out.
We are here for you. Thank you.